Hi everyone, this is Demel Gonzalez of Heartwood Financial Services. Welcome to another edition of the Market Update. I hope everybody's doing well. I know it's been a long summer. Kids are back in school, thankfully. I think we're all pretty much ready for 2020 to be over. And it doesn't help now that we have elections coming up. So we get to, all we can do is really watch TV, and now we get to watch all these ads. I'm feeling your pain too, believe me. Enjoy the video. It's a little bit longer. There's a lot that's been going on lately. You've probably seen the market react almost violently in the last few days. I'm going to be touching upon that. It's about 17 minutes for the short version and about 28 for the extended version for my hardcore, detail-oriented people. So thanks for tuning in. Enjoy, and of course, don't forget to share. Thanks. All right, let's get started with the asset class returns. The month of August was the month for large cap tech. As you're going to see here in a minute, large cap was up over 7% for the month, now almost up 10% for the year, doing the best as far as the stock market goes. Pretty unbelievable. Although if you've been watching the market the last couple days, there's been a little correction to that. And then we're seeing the small caps improving as well, not quite as much, up 3.99%, almost 4% for the month, still down for the year. Real estate slowed down quite a bit in August, barely up, still a little negative for the year. The developed markets has continued to do pretty strong. As you can see, there was a close second, up 5.48 for the month. Just a little down now, about -3 for the year. Emerging markets continue to do well. They were the big winners last month. Not quite as well this month, although still pretty darn good, 2.71 for the month, and now finally positive for the year. Fixed income, a little different story. Your conservative bonds, aggregate bonds, what I say. These were down a little bit for the year, about 1%, just a little less, but still a nice return year to date. High yield also up a little bit, but not quite as much as stocks, of course. But for bonds, it's up and now beating the conservative bonds, the high yield. And then finally, gold. Gold finally took a month off. It's been so high. You can see how it's up 29% for the year, and it was down just a little bit for the month. So here are the asset class returns. Again, telling you how important it is to keep that diversification, and there could be a little bit more of a changing of the guards, which is what we're seeing here in the last few trading days. So the title of this month's update is the Worst Over? And I'm going to try to make my case here because I have an answer. And so I'm going to start off with, first of all, we're seeing COVID cases continue to drop. And so that's been a very good sign. It's not just flattening out, it's actually dropping. So that's very encouraging. Deaths have been lagging, and so they're now starting to drop as well, which is very important too. And so that is a very good sign. I think we've probably seen the worst of the COVID cases. That doesn't mean there can't be a spike. A lot of people are concerned about the fall and winter. But getting back to what we were seeing in March and April, just don't seem that likely. And I'll talk a little bit more about that in the extended version. Consumer spending is up, and that's despite the delay in the fiscal stimulus. A lot of folks thought August was going to be a bad month. The fiscal stimulus has stalled. Nobody's getting that extra unemployment benefit, but yet the consumers still spent a little bit more. In fact, we had some great numbers from retail sales. Now, there's some interesting facts about that I'll get more into with the extended version as well. The leading indicators continue to improve. I'll show you that it's pretty much across the board. One in particular I'm highlighting here is the manufacturing PMI. which has actually been improving 4 straight months in a row. And that's the one that's kind of the hard one to move up because it's the manufacturing. So that's a very encouraging sign as well. The initial jobless claims. Now this is what comes out every week, and it shows the new people that have been added to unemployment or have been applying for unemployment. And the numbers have been really high. They've been over 1 million for basically since April, and they have been coming down, and they continue to go down. So this week we saw only the second time that it got under 1 million. It was almost 900,000, which is still very high, but it is continuing to go down, and that was the trend for August. Again, when it was supposed to be kind of a bad month due to the stall in the stimulus. And lastly, we saw how the unemployment report came out today. This is breaking news here, guys. So the unemployment report was very good. We were almost at 1.4 million additional jobs added for the month of August, and we brought down the unemployment rate to 8.9%, which is pretty amazing. We didn't think it was going to get below 10 until the end of the year. We're already below 10, and it's September. So this is pretty impressive. So again, this was despite the fiscal slowdown and not getting those extra unemployment benefits. So we're showing that the overall market is, or the economy, I should say, is improving, which shows that the market essentially was right in going up over the last few months, anticipating this. Now, I would claim at this point that I do believe the worst is over with the COVID, and the worst is over for the recession, but that doesn't mean we can't stall or even slip back a little bit. I just don't see us going back to where we were in April, March and April. So I do think that they do need to get some stimulus done. That is going to really push us over the finish line to get us to the vaccine, because the vaccine is truly when things will start to really accelerate for the economy. Okay, and for the outlook, the title is the market expensive? Because I would imagine a lot of people would probably say, yeah, Demel, I think I agree with you as far as your assessment so far of the market. I think maybe we are past a high, but didn't things get a little out of hand with the market? It's gone up so darn much, and it's definitely true, and there are some ramifications to that, and let me explain. So first of all, the answer is yes. The S&P 500 is expensive. You know how I like to get into the math of the market, and right now when we look at the math of the market, the stock market in general looks like it's about 20% overpriced. Now we can make the argument that next year is going to look a lot better than it's going to be, or what we're projecting, and that could very well be the case. I hope that's the case, but the stock market is looking pretty expensive overall. Now that's not the whole story. The stock market is really made up, and when I say the stock market, oftentimes we're referring to the S&P 500. The S&P 500 is made up of 500 stocks, and they're not made up in equal weights. So this is something a lot of people don't understand. They're made up in the percentage of their size. So the bigger stocks represent a bigger part of the S&P 500. And so if you think about it right now, the S&P 500, those 500 stocks, the top 5 stocks make up over 20% of the S&P 500 right now. And you guessed it, they're Amazon, Apple, Netflix, Facebook, Google, Microsoft, companies like that. And so with them representing such a big part of the S&P 500, they really are the ones that are dictating how the S&P 500 has been moving and how it's been priced. And those tech stocks have been really expensive. And if you watch the extended version, I'll get a little bit more into that. But what I'm trying to say is because those tech stocks represent such a big part of the S&P 500, the S&P 500 looks expensive. But those other 490-something stocks are not that expensive, and we'll get into that a little bit more in the extended version. So the point here, and I already alluded to it, there are plenty of good values. There's a lot of pretty cheap stocks out there. In fact, most of the stocks have not caught up to where they were back in February, even though we've seen a lot of things improve in the economy and a vaccine that's, at least with a light at the end of the tunnel. And so there's a lot of good values. I'll talk a little bit more about that as well in the extended version. The other thing is the Fed has had some would say a big change in tune in what they're doing with their monetary policy. Some people might think it's not that big of a deal, but I thought it kind of was. They basically said that they're having a hard time getting to 2% inflation. And so in the past, they've given the impression that when we get close to 2% inflation, they're going to start raising interest rates, kind of slow things down. They don't want too much inflation. The problem is we haven't had that much inflation. We've rarely even got above the 2%. So now what they're using this word called inflation averaging, phrase I should say. And the inflation averaging basically says that, well, we can maybe overshoot 2% as long as the average is somewhere in that range. And so it's basically a very dovish statement. They're saying they're going to really play it slow and raising interest rates. To me, this basically means the Fed is going to be dovish for longer. And remember, dovish is very easy with their policy, keeping rates low for probably longer than many people expect. The other thing is August unemployment report. I just talked about that in the update piece. It came out pretty good, but it was really a win-win no matter how it came out. If it came out bad, that would put pressure on Congress to actually do something and get that fiscal, CARES Act Part 2 passed. If it came out good, that just means the economy is getting better than a lot of people thought, and things are hopefully starting to get a little closer to back to normal. So I thought this August unemployment report was really going to be pretty good either way. And finally, the way that Heartwood is starting to position now, as you can kind of see in the tone of my voice, I'm kind of optimistic. Now, the last couple days has been a little bit of a gut check, and I think that that talks more about item number one, where the S&P was probably a little too expensive, has mostly been led by the tech stocks going down. And so what you're going to see and have been seeing with your portfolios over the last month and probably over the next few months is continuing to rebalance and take some cash off the table of those winning tech stocks, mostly large cap tech stocks, and moving them or rebalancing them into more small cap, international, and also more value-oriented stocks. Now, this doesn't mean we're getting out of tech and going into these different areas. It's not what some people call a rotation. It's really more of an incremental rebalance because tech's not going away. It's definitely the future. They're great companies. They just got a little expensive. Capiche? So for the educational piece, I got government control. Now, some of you might have been thinking it was a different type of piece. But what I'm trying to talk about here is how the market does when there's a certain party in control of the government. And what's difficult to find is usually the studies are done on who's in charge of the White House and then gives you the returns on the market. But it's really more than just the White House. It's very important to consider Congress as well. In fact, I would argue, based on what I've seen, it may even be more important, okay? And so this chart from JP Morgan did a nice job of incorporating how the returns when there's a control of both Congress and the White House. And as you can see, when Republicans were in control, the market was up about 11.8%, Democrats about 9.2%, and when it was a divided government, it was up about 6%. So first of all, they're all pretty good returns. I was a little surprised by divided government. I thought that's usually a little bit better. But the returns for both Republicans and Democrats were pretty good. Even though the divided government happens more often, it was actually the worst. And on GDP, it was slightly different. For GDP, the Republicans actually had a 2.8 GDP, which was lower than the Democrats at 4.4. So it's kind of interesting, right? The market did better during the Republicans, but the GDP wasn't as good. And so it's interesting. It's hard to really know exactly how that would work, but that is the figures. And divided government actually had the worst again as far as GDP, which happens the most often. I guess what I took from this was it's more important to look at just who's going to be the president. It's most important to look at, both parties and the White House and Congress. And to me, you could see that pretty much in all scenarios, the market seemed to do pretty well. I think what the market doesn't like the most is just the uncertainty that leads into an election, especially if it's a contentious election like we're looking at here. So obviously, we'll be keeping a close eye on that. But overall, it's not as big of an event as people think. All right, and the last thing I wanted to share with you, you always know I like to end with an inspirational note, is I was reading an article that had this great quote in it. And so I titled this little talk here, "Who is Ready to Listen?" I know sometimes I'm not the best listener. And this quote really grabbed my attention. It says, "Most people do not listen with the intent to understand. They listen with the intent to reply." It's, of course, a Stephen Covey quote. And I just think, that's probably me sometimes too. We get in a conversation. Usually it's the heated ones, right? Where we're already thinking about what we're going to say rather than truly listening to the other person. Wouldn't it be great if we could all be better listeners instead of, arming up your next reply? And so I wanted to share this with you. Maybe you feel like sometimes you run into this issue. I know I do. I will promise to try to be better at this and listening rather than, whipping out that next factoid to prove you're wrong. I'm guilty of that. But I hope this helps. Hope this is a good reminder to, it says that, we have 2 ears and only 1 mouth for a reason. Bye, guys. All right, if you're still on, that means you're my hardcore followers that like to get into the nitty-gritty. This is the extended edition. And first I wanted to start off with talking about the COVID cases. That's really the number one thing I've been watching. Every morning I wake up and I pull up the numbers. And what you can see here is the numbers have been coming down. So it's a really good sign. You can see the case numbers have been coming down, and finally the death numbers have been flattening out as well. Of course, that lags, so that makes sense that that's happening. So I hope we can keep this up. There hasn't been any big spikes yet with some of the schools reopening, so that's also a good sign, but still a little early to say that we're past that phase. But again, what I see so far is very encouraging. And here again are the leading indicators, showing them from last month to this month. And the thing to really look at is the red square. That's the average of all the leading indicators. The top line, top half, I should say, of the chart shows that things are growing. And when it's on the right side, that means it's accelerating. So what you can see from this chart is we are continuing to accelerate and grow. So it's been very good to see this. I think the acceleration has maybe slowed down a little bit due to the fiscal delay that we talked about in the first part of the video. But you can see how everything is still continuing to improve very nicely. We are basically now, for the first time, in an expansion quadrant. This is usually a sign when even the stocks that have been beaten up that are more cyclical start to outperform, like small caps, for example. And of course, you've been hearing me talk about the initial claims report. This is how many people are applying for financial assistance, unemployment benefits. And you can see, of course, how it's been coming down pretty dramatically here since the war started in March. But what's nice to see is that we're actually starting to get below that 1 million. Now, this is still a really high number. I'm not, saying that everything is great. We're far from that, but we're showing signs of improvement. And for the stock market, the signs of improvement in initial claims is a real big positive and leading indicator for the market. So that's why I've been watching this so closely. And it does continue to improve, again, in spite of, or despite, I should say, of the the stalls and the fiscal stimulus. So sorry, this is probably my most boring chart. It's the one that I make. So I won't belabor this one too much, but when we talked about the valuations of the market, again, talking about the S&P 500 generally when we say the market, the bottom line here, as you can see, is the market is about 21% overvalued just based on the price where we were at today versus the price that I'm projecting we should be at in a more normal valuation. And I even include what I call a PE multiplier, which takes into consideration the low inflation, low interest rate environment that we're in. But again, like I talked about in the outlook, it's really because of that concentration of tech stocks in the indices. It doesn't mean that the overall market is overpriced. It just means that there's a concentration of a few stocks that are really overpriced. Here's another very interesting chart to kind of emphasize the point of the few stocks that are really making the market get a little expensive and have also led the market higher. The blue line is the S&P 500, the regular market cap weighted S&P 500. The red line is the S&P 500 equal weight, meaning every 500, all 500 companies has an equal weight in the index. And as you can see, the regular S&P 500 has done a lot better, although recently, we've had a nice little dip there. But you can see that the performance is huge. The numbers I think there are a little small, but it's like positive 5.5 for the S&P and minus like 4 for the equal weight. That's almost a 10% difference in the performance, which is pretty big. And so there's probably a lot of stocks that are in that other 495 that are still not too expensive. And you can also see how the red line is still not to where it was back in February, where the blue line actually passed it up, and now we're right back to where we were in February. Pretty interesting. So in the outlook, I was talking about how we're doing some rebalancing, moving some money out of those more expensive tech, little by little, again, not a rotation, but a rebalance, and finding the things that are a little bit more attractive. Well, you can see here, this is a chart going back to 1952 of the areas of the domestic stocks that have done the best. And what you can see there is in the green, the small companies have done the best. In particular, small cap value stocks have done the best. But for the last 10 years, it's been large cap growth. And so reversion to the mean, I'm a big believer in this. And I think what we're going to start to see, and we're starting to see it now, especially after these two big moving days, is that there might be a little bit of a changing of the guards. People are starting to realize, wow, this large cap growth is really expensive. Maybe we have to look at other options, take a little money off the table. I think that's what we're seeing, and the areas where we can probably take advantage is in that value area and in the small cap in general. Has underperformed historically, and probably as it reverts back to the mean will perform better than it has in the recent last 10 years. So that could be a good opportunity. And I wanted to show you this chart real quick. I talked about how the Fed kind of changed its tune a little bit. The title here is the Fed has been missing the target. And so 2% is right here. The orange line is basically what the Fed looks at as the inflation number. And as you can see, we're way below that. In fact, the average for the last 10 years has only been about 1.54% when they've been targeting 2. So you could see, just to get us back to a 2% long-term average, they're going to probably leave interest rates alone for a long time, let inflation even go up into this range, and it could be a few years. And so that's why you can see how I really think the Fed is going to be fanning the flames, so to speak, of the stock market here for several more years to come. And the last chart I'll show you is the VIX. I've been showing this one a lot just to give you an idea of the fear index, otherwise known as, and showing you how the fear is kind of starting to come back. And it's really been coming back here in the last several days. We've seen the market become a little scarier with some of the drawdowns in the market. But we're still far from where we were back in March and April. But it is getting back into that zone where people, I think, are being a little bit more cautious, which frankly I think is good, because I think the market got a little ahead of itself, especially in the large cap tech area.